Welcome everybody to today's call. We have a special guest on. I am going to play host before I introduce this individual from InvestWise Capital. I'm going to go through just a few minutes of what we offer here at Sense Financial. As an encouragement, if you do have any questions, please type them into the questions or chat, and we will definitely give time to ask those at the end. I encourage you to ask the questions throughout as they pop into your head, because at the end, you probably won't remember them. So go ahead and feel free to do that as we talk, and then we'll address them at the end. And so this is the insider secrets to value add strategies for real estate investors. And yes, InvestWise Capital is my guest, Scott Kirchner, who I will officially introduce here in a few minutes. But first, just a little bit on what we do here at Sense Financial. My name is Brett Sadinsky. I'm a solo 401k self-directed IRA consultant here, and we are not a fiduciary. We don't offer legal or tax or investment advice. This is educational only. So if you need advice, please seek the services of a competent professional. And so Sense Financial, we are a boutique financial firm specializing in self-directed retirement accounts. And we think what separates us from the other firms that offer what are called full custodial accounts, all of our plans have control, giving you as the investor the power to make your investments without any sort of red tape to go through. We've been serving clients since 2010. We have lots and lots of reviews all over the place. And we have to date assisted over 3,000 clients establish well over 4,000 self-directed retirement plans. And most of our clients, which I think is a testament to our level of customer service, actually come from referrals. Just a little bit on the benefits of what we offer in the self-directed IRA and solo 401ks. These allow you to invest in alternative assets, right? So you have your traditional investments like stocks, bonds, mutual funds, but with our plans, you can invest in real estate and cryptocurrency and precious metals and just about whatever you want. So you can get true diversification by doing this. The investment returns are tax deferred in the retirement account, traditional, or in the Roth. Of course, it's tax-free investing. All the money invested is paid. The principal is taxed already, but the gains and everything put into it from there on out from investment returns is tax-free upon withdrawal at retirement time. And you can leverage your funds with non-recourse financing. And we already talked about checkbook control. And then it truly is, the solo 401k is a true tax shelter, because if you're self-employed, you can contribute up to $76,500 annually into your solo 401k and direct that into whatever asset class that you would like. And just one quick topic on prohibited transactions. Internal Revenue Code 4975 says there's three things, okay? Collectibles and life insurance. So you can't invest in coins or baseball cards, that sort of thing. And then life insurance, unfortunately, is prohibited on the IRA side, not on the solo 401k side. But for both, you cannot do collectibles. And then you have the disqualified person restriction. So you, your spouse, your children, their spouses, your parents, your grandparents, that vertical line of descendants are disqualified people. So you can't invest in any businesses that they have the majority ownership in, or and you can't give them money to go buy something and invest with them or anything. So those are disqualified. And then the collectibles and life insurance are prohibited. And I mentioned this, but I'm just going to hit it real quick again. You can invest in literally unlimited options: commercial real estate, residential real estate, trust deeds. You can actually become the bank. You can originate loans. You can loan money and get a return. You can invest in funds that loan money to fix and flippers and get a return that way. You can invest in syndications, which we're going to be talking about today. You can invest in precious metals, crypto. Literally, it is almost unlimited what you can invest in, except for what I mentioned on the prohibited transaction rules. And this allows you to truly diversify. And so, you put all your eggs in one basket. You might have something like this happen, like what a lot of people saw in 2008 and 9, and around that time when people lost 50, 60, 75% of their portfolio, quite literally overnight. So Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And so you work hard for your money. We want to come alongside and work hard for you as well. And so the solo 401k or investing into alternative assets can provide a true diversification. So I'll leave it at that. That said, I'm going to stop sharing, and I'm going to let my co-host here take over. I'd like you guys to meet Scott Kirchner from InvestWise Capital. Scott hails from the great state of Minnesota, to which someday I strive to get to and see. Haven't been there yet, but he says there's great weather today, and so hopefully that persists. But Scott's going to be talking about something that I think everybody who's interested in real estate, I don't care if you're interested in investing in real estate with your retirement account or not, adding value to your real estate, whether it's a single family home or a multifamily, is something that we can all learn from and basically serve the tenants better and put more money in our pocket over time as well. So without further ado, Scott, thank you, sir.
Awesome. Thanks so much, Brett. I appreciate the introduction. I'm going to share my screen here as well. Thank you for having me today. It is beautiful weather, and I'm happy to be here and sharing with you all today. So I appreciate the opportunity. Alrighty, if someone can give me a thumbs up that they can see my screen, should say InvestWise Capital. Perfect. Fantastic. So a little bit about myself. On the left, you've got my prior career. So prior to getting into commercial real estate, I had 15 years of experience in law enforcement, and I had been passively investing in other syndications, specifically multifamily. And so the way that goes, as many of you may already know, you get different offering memorandums from different sponsors and things. And I had been shopping those and, passively investing my money as a limited partner in those syndications. And I genuinely was enjoying it and having fun with it. As I continued my career in law enforcement, my focus kind of began to shift as we had a family. I've got 3 little girls right now. My wife and I have been married. Actually, we're celebrating our 10-year anniversary here on Friday. And we've got 3 little girls. And as any parent in the room or on the presentation knows, kids will change your perspective on life. And so my focus kind of shifted, and I realized that I had the strong interest in real estate, specifically multifamily, and was genuinely enjoying my time with it, and kind of thought, well, why don't I begin to pursue this as well? So I did begin to pursue it and purchase my first deal, which was a 36-unit opportunity for just over a few $1 million back in 2019, where I raised outside capital for that deal. And that's kind of where it all started and where it's at today. I'm nearly 300 units of multifamily at this point, participated in $30 million of real estate transactions thus far, and continuing to actively shop in this market and going forward. So as far as InvestWise Capital goes, like I mentioned, I raise outside capital from investors. We follow SEC regulations. And so it is open to accredited investors because we do publicly market our offerings and information. So making sure that those that we're working with do have that accreditation is a prerequisite to investing as a limited partner alongside us in our opportunities. And we put together the offering memorandums and packages and everything with private placement memorandums for everyone to review as part of the process. And so today I'm going to talk specific to the value add strategy. For those that may not know, commercial properties, we have to first understand how they're valued. And they're valued by an NOI divided by a capitalization rate, which is kind of boring. But the gist of it is your net operating income is take all of your gross revenue and income for the year, subtract out all your expenses, including property taxes, insurance, payments, and get that bottom line number. It doesn't include your principal and interest payments to your mortgage, but it includes every other expense of owning and operating that property. And in that, you get your bottom line being your NOI. And so in order to value a commercial property, the net operating income, that bottom line, is divided by the market capitalization rate. For instance, in the market I'm in here in Minnesota, currently today, our cap rate is somewhere between 6.5% and 7%. Depends a little bit on the deal and the type of asset. Something that's a brand new build or new construction with granite countertops, stainless steel appliances is going to command a little lower cap rate, which will increase the value of that property. So knowing how commercial properties are valued, in that it's the bottom line of that property divided by the market capitalization rate, the easiest way to force appreciation to that property or add value to it is to increase that bottom line or that net operating income. So in any real estate realm, we have natural appreciation. Natural appreciation occurs within the markets as the cost of inflation goes up and the cost of living goes up, right? A home that you bought 15 years ago for $400,000 might now be worth $600,000, for instance. That's the natural appreciation of a moving market. But when we do a value add strategy to a multifamily property, for instance, we are forcing that appreciation because we're driving up that bottom line. And this can occur in several different ways. One of the generals that I've had good luck with in outstate, more rural markets here in Minnesota is rent increases. Now, I'm not saying we come in and we buy a property and just raise everybody's rents overnight. That's not what I'm about. We're still providing housing, and there has to be a fair exchange of value there. What I'm talking about in rent increases is recognizing when a property is truly under its market rents. That comes through market research and analysis, pulling different data points from numerous different sources to truly understand what is the market rent for a one-bedroom unit in this city. So when I found some properties in outstate Minnesota and more rural communities of 20,000 people or so, instead of here in the metro, there are opportunities that exist with mom and pop type operators where if the market rent for a unit is $1,200, they might only be charging $1,000. And so in that case, we have a natural case to show here are rent comparables that justify this rent. And we're simply able to slowly increase the rent. We try and do it over like a 3-year period to existing tenants, just so it's not such a cold approach to handling that. Other ways that can occur is operational efficiencies. I always come back to the story of the first building I bought and owned. I toured at 11 a.m. on a blue sky sunny day in Minnesota, and all of the parking lot lights were on. And I made a note to myself that we're obviously wasting electricity, or the owners of that property at that time were. And so once we closed on it within that first week, we figured out where the timer was for the outside parking lot lights and adjusted them. That's one small example, but in the totality, when you have little things like that add up, there is a real cost saving benefit there. I can talk a little bit more about that in water consumption in a few minutes here. But then one other way to increase that bottom line is by adding additional revenue streams, charging for pets. For us at our properties, it's $30 for a cat and $50 for a dog per month. Garage parking. This is one that I every now and then have people kind of look at me a little funny, but here in Minnesota, we get snow all winter and it's 0 degrees or sometimes 20 below with the wind blowing. And people want to have their car in a garage so they don't have to scrape snow off and things like that before they go to work. So we can monetize that and we can charge for it depending on where you're at. A garage in Minnesota right now and some of my more rural properties, that's $45 a month. In other places here in the metro at another property I have, we're charging upwards of $75 to $80 a month just to have a garage parking spot. Those garages are already there. We're not building them. We're just recognizing that there is value there and that people are willing to pay for that. Storage spaces, they're a great asset if they're already there. The reality is you can maybe get about $10 a month for them. So they're not huge, but it does help that bottom line because you're not having to do anything to get there. Reserved parking and a RUBS policy. RUBS is just a fancy way of saying utility bill back. So things that the property owner is already paying for, such as electricity for common areas, water, sewer, trash, and pest control, you can, on a pro rata percentage basis, bill that back to the tenants so you can recover some of your operating costs for that. And those are all combined. Those are different ways that you can increase that net operating income. And so, as I alluded to just a moment ago, it's all about the equity. But before any of the value creation can occur, human equity has to genuinely be created first. I don't like being on the front page of the newspaper. I'm a compassionate individual. Yes, I'm in this industry to make money for myself and my partners and limited partners as well. But at the end of the day, I'm still a human being who's a compassionate individual. And so one of the first things I do whenever I acquire a property is I find in week one, I call it kind of my week one project. So when I'm buying a property and I'm doing my due diligence, I identify a handful of things that can be done in the first week. In one property that I bought that was pretty small, it was changing out smoke detectors that were expired and outdated. It's just kind of a good way to make an entry point to the tenants there, who are usually a little uneasy when new ownership comes in, new management. It makes it a little uneasy when it's your home. And so I try and find something that I can do, and I genuinely want to do it, but do it in the first week to show the tenants that are there, that are living there and calling a place home, that, you know, we're here to make things better and improve the property. Yes, at some point we will need to be financially compensated for that. But in the meantime, our first foot forward is that we're here to add value. So beyond that week one human equity creation that I like to try and focus on, additional updates are made to the property over time, and they can vary drastically. Like I had mentioned a moment ago, in some of my outside properties, this is just catching the rents up to the market rent. At other properties, it gets very different. I'll show you a few photos here. So some of the physical value add, this was one of my first properties back in the day. This was the laundry room at a fourplex that I owned. The photo on the left is the picture, not even from the day I bought it, because I went in and I had to clean stuff out before I could even take a picture in the room. And the second picture is after we were done with it. Is it perfect? No, but again, it's a fourplex. You don't have a lot of space to make changes and things like that. But painting the walls, squaring off the washer and dryer, retrimming the window, fixing the ventilation, adding a new wash sink, and just painting the floor with concrete paint make a very big difference. It's a relatively cheap project, and this was actually one of the things I did as kind of one of my first week one projects at this property to show, hey, we're going to clean things up here and make it better for you. This is an example of most recently the property I just closed on. It's a 71 unit property here in Minnesota that was closed on just back in March. And so this is a full true value add property. Again, this is 71 units with a lot of common spaces and areas. At this property, the picture on the left is how we bought. Probably about 20% of the units had this flooring here on the left-hand side. The remaining 80% still had linoleum from when this building was built. So this property we're going through, and we are fully renovating all 71 units. We've got about 30 of them done so far since March. And we are also updating all the common spaces as well. And as you can see on the bottom here, this unit on the left was a 2-bedroom unit that was renting for $1,089 per month when we bought the building. We have now completed the renovation in that, and that same unit, literally this is the identical unit, is rented for $1,450 a month. And so obviously a lot of value creation towards our bottom line there. We had to spend money to get there, which I'll touch on in a moment. This is that same unit. The left side is the bathroom when we bought it. The right side is the bathroom today. Again, it's same unit, so same rent increases there. Interesting thing about this property, when I talked about sewer and water and operational efficiencies, when we toured this property, we noticed when we did our unit by unit inspection, we noticed 12 toilets that were running in units where no one was home as we went through all 71 units as part of our due diligence. And we already had a clue that the water usage was high at this property. Their annual water bill was about $90,000 for the year, and it seemed high even for the number of units. And so as we did our due diligence, we noticed, that we happened to walk into 12 units that happened to just have the toilet running the moment we walked through the door. We only spent a few minutes in each unit. So the odds of us hitting all of them, it's very, very rare that we would hit them all. And the fact that we hit 12 in a row was a big clue. So things like that, going through and just replacing flapper valves, obviously, because we're fully renovating, we're doing all new toilets, all new plumbing fixtures in this one. But water usage, is surprising as it is, a lot of water can get wasted in a hurry. And so we were happy to get that dialed in at this property and continue that. But just another way of how we're increasing operational efficiencies to reduce our expenses, which in turn then falls to our bottom line and drives up that value through net operating income. So in the end result, in the case from the photos there, the last two photos of the kitchen and the bathroom, we're adding $361 a month of additional rent. When we take that out across all 12 months, it's an additional $4,300 a year. Our cost to renovate a two-bedroom unit at that property is about $16,000 per unit, including updating the electrical panels in those units. So we're roughly at 27% ROI. So we'll get our money back in about 3.5 years through those rent increases per unit on those renovations. So $361 is a little bit high. That's one of the lower rents that we then were able to bump up to our market rents with a renovated unit. On average, at that property, we factored in $300 a month of increased rent per unit. So when we take that across all 71 units, we're just over $21,000 additional income a month. And on an annual basis, it's $255,000. So if we take just that $255,000 and divide it by the 6.5% market cap rate, that results in an additional $4 million of value being added to that property. Our renovation cost at that property is about $1.8 million. So we're certainly gaining all of our money back in value and then some. And so that's how, when you increase your rents, whether you're renovating units or just catching up to market rates, you're reducing your water costs in our case, amongst other things, to increase those operational efficiencies. That is how you can drive the value of the property to be much higher. The conundrum, though, that comes in, because at first we're concerned about our ROI. What's our return on our investment? If I put $100,000 into this deal, what am I going to get? Am I going to get $10,000 at 10% a year? What's my return on my investment? But the conundrum becomes, once we add these millions of dollars of value to the property, while we're simultaneously paying down the principal balance of the mortgage, we run into an equity issue, where we now have a gap here. And I don't know if you can see my mouse on my screen, but we have this gap. So if we consider the orange line to be the value of the property and the blue line to be the declining mortgage principal, because we're making principal and interest payments as we're adding value to this property, we get this gap in here that is all untapped equity. So we're now no longer concerned so much of our return on our investment as we're concerned of our return on our equity. We get this big gap here, and it gets worse the further out you go, because your mortgage continues to decline, and in theory, your property continues to get 3% rent increases. Yes, operating costs go up as well, but the rent increases typically offset, and then some, the operational expenses that go up. And so we look at how we can capitalize on this equity. So in the property I'm referencing today, the 71 units that we just bought in March, we'll do a cash out refinancing year 5 of that property as a result of the added value, which will result in all of the initial investor equity being returned in year 5, in theory, based on pro forma underwriting. Yes, we underwrote for high interest rates, not a 3% interest rate in year 5. We're factoring in market conditions and things like that as well to make sure we're not missing the mark there. So it's a little crash course, but it's interesting because it seems like every offering that I see across my desk is this is a true value add. It's a value add. And so what you want to consider from a limited partner standpoint, if you're considering these opportunities for investment, you're going to want to look at that and understand in their financial modeling how that sponsor is going to raise that net operating income to get to their proposed valuation at a refinance period. And obviously, you'll also want to look at the capitalization rate. Those are the two factors that come into this, to make sure that their capitalization rate is either flat, meaning it's staying the same at, in my case, 6.5%, or that it's increasing by 0.05% per year, to factor in for different market conditions and things like that. To me, that's always the case of a sponsor trying to under-promise and over-deliver, versus other cases I've seen where the capitalization rate is declining, and when that cap rate gets lower, the value of the property goes higher. And it seems to be a way in which sponsors are inflating their their projections and things like that. So just kind of my quick tip on, if you're looking at a value add investment opportunity, how you can truly evaluate and understand how those metrics are going to be met. The net operating income, are they raising rents? Are they reducing expenses? How are they getting there? And what are they doing with that cap rate once they get there? So there's obviously a lot more that goes into it. Spreadsheets and of 12 tabs long for me when I'm underwriting these deals and things. But like I said, it's kind of become a buzzword and a buzz topic of the value add. And I wanted to get the information out there in front of different individuals who may be researching these investment opportunities and considering them, and just make sure that you have the information readily available to yourself to know how to assess those opportunities and understand them a little bit better. So I'd happily stand for questions if anyone has any. I don't know if any has been dropped in the chat or not here, Brett.
Yeah, no. Well, one question I answered about precious metal investing, but other than that, nothing right now. But yeah, I actually had a couple that maybe this can spur some more questions on. How long would you hold, like the 71 unit? How long would you hold on to that property?
That's a great question. I'm sorry I hadn't touched on that. I'm a buy and hold guy. I'm a bit of an anomaly in what I do. A lot of the offerings that I see, and that frankly that I invested in prior to, they're a 3 to 7 year exit strategy. I do not do that. I believe in getting the property stabilized at a position that I would like to operate it and be proud to own it at, and then I hold it. So we try for a cash out refinance in that year 5 that will allow for initial capital to be returned. Other properties that I have that the value creation is there, but it's in a rural market. So it's maybe not as aggravated as a suburban market like here where I'm in the Twin Cities area. We're looking at kind of our coupon rate. We're clipping coupons, as we say. So for instance, several of my properties this year, we're collecting over 10% cash on cash return to investors this year. Where, if you had $100,000 in, you're maybe getting $10,000 to $12,000 showing up in payments throughout the year. A couple of reasons why I don't believe in selling. If I have a good asset that's performing well, I don't know about you guys, but I consider a 10% return very good in this market, along with the depreciation that comes along and the tax benefits that come along with owning and partnering in real estate opportunities. If I sell that property and say that I was getting 10%, I was getting $10,000 a year, I sell that property, sure, I get my $100,000 back and maybe a kicker, but that revenue stream has dried up. And myself and those in my network that I partner with, they're looking for the long-term kind of recurring payments, mailbox money, as people call it, right? Or doorstep dividends, as I like to call it, where you get a check on a recurring quarterly basis or every other month type of deal. And it's almost like a source of income or a payroll to some degree. And if I sell the property, I have to figure out where to redeploy that $100,000 to get equal to or better than the same return. But odds are that property is going to have to take some time to scale up. And so I feel like the time value of money causes that return to be reduced a little bit. So I believe in long-term holds. And the last part on that is the tax aspect. When you sell a commercial property like that, you not only get hit with capital gains tax, so anything above your initial investment becomes profit as a capital gains, and you're taxed at the capital gains percentage for that. And you also have what's called depreciation recapture. So in a commercial property, we're depreciating the asset over in multifamily case, 27 and a half years. And so you get to offset your income through depreciation over that 27 and a half year period. But if you sell the property, not only do you have to pay capital gains, they also come back and look at the depreciation that was written off and they recapture that. So there's a massive tax liability in selling a property. At some point, will I sell some of mine 25 years down the road? Potentially. And the argument there is, my $2 million building that I bought, my first one back in 2019, that one arguably today on a couple broker opinion of value is worth $3.5 million. I figure another 15 years from now, it'll be well worth over $4 or $5 million. The mortgage will be close to paid off. And so we'll have a ton of cash where we can do a 1031 tax deferred exchange. We don't get on the hook for depreciation, recapture, and capital gains. And we are then able to redeploy a massive amount of capital into another property and asset.
Perfect. Great answer, man. Appreciate it. And the initial investors would need to stay with you on the 1031 in order to not incur all the depreciation, recapture, and all that good stuff. Is that a requirement, or can you have like some of the initial investors stay with you and then add some new ones, or does it have to be kind of like an all or nothing type of thing?
Yeah, the LLC has to remain intact. I've done one 1031 exchange so far on an exit that I had and had a great opportunity there. And that one, it was a small ownership group. It was actually just my wife and I. And so in that one, it was obviously easy to keep the LLC intact. But in talking with the 1031 intermediary in that case, as well as my attorney, the language that kept coming up was that the LLC has to stay intact. And so I don't know if some members can exit that. But in saying that, I intentionally keep a tight-knit, smaller group of investors. We raised about $3 million for the deal in March, and there's about 20 people into that deal whom we have relationships with and friendships with, and we all have each other's cell phone numbers and email addresses. I'm very accessible to any limited partner that I have. And so in keeping that tight-knit, it allows for more of a conversation as a group on what we want to do and how we want to do it.
Awesome. Okay. I only have one more, and then my question did spur some others from the audience here. So we're going to get to those, but this is probably a quicker answer, hopefully, because I do want to get to some of their questions. But this is essentially, so you update all those units, 3.5-ish years, your break even. How much more time would go by where you're in that profit mode before those units would have to be updated again? Is that like maybe 10 years or 15 or 20, or what do you think that would generally look like?
You know, it varies for every operator. For me, it's at least 15 years. And you've got to consider that we're doing flooring. I mean, short of ripping sheetrock out right now, we're changing everything in those units. But you can paint a unit for, I think our painting costs about $700 or $800 a unit. We can paint a unit for less than $1,000. We can do flooring for a couple thousand. So we can change the physical appearance just by paint and flooring alone for probably less than $4,000. And I'd push, flooring is pretty good product, the LVP, it'll last a while. So we're at least 10. We want to try and push it out to 15 years. And then at that point, your mortgage principal is much less. And so, your rents maybe aren't as, you don't have to get as high rents to justify, if the market's 1,700 and you're at 1,600, you're not losing money because your mortgage has gone down, your expenses have gone down quite a bit.
Perfect. Cool. All right. Thanks for that. Okay, Eric, thank you, Eric, for your question. Eric is asking, are you currently shopping for multifamily? How are you financing properties? And with rates having gone up and lenders being more conservative, how are you getting deals done in this environment? Good questions, Eric.
Yeah, great questions, Eric. Yes, I am currently shopping. Before we got on the call here, Brett and I were talking. I was at a property earlier this week touring it that's on the market. I toured 2 in the last week and a half as well. So actively touring properties and, underwriting and making offers and trying to get them. Financing right now is being done. I don't have any agency debt through Fannie or Freddie. All of it is local banks actually right now that I've got good relationships with. And Fannie and Freddie are great as well. But, when you're doing a value add, the cash flow is typically a little lower than what Fannie or Freddie would approve. So you end up at a regional bank probably to be able to pull that off. So that's what we look at. One good point to illustrate is all of our financing is non-recourse to any limited partner. So I personally am signing a personal guarantee, but it is non-recourse to any limited partners. There's no liability if the building were to default or anything like that to any limited partners. So I always assume that risk and take it on as the sponsor should, in my opinion. Rates going up and lenders being more conservative. How are we getting deals done? Bring a little more cash to the table. The other side of that too is my underwriting is reflective of interest rates today. So, when I was underwriting in this last week or so, I'm underwriting about a 6.6 to 7% interest rate based on my relationships with lenders and knowing kind of where they're at on their lending rates today. So my underwriting is specific to interest rates today. And what you need on a commercial loan is what's called debt service coverage ratio. So for every dollar of debt that you owe, a bank will typically require $1.25 to $1.30. So 1.25 to 1.3 of net operating income. And so when I size up a property and underwrite it, I can look at it and say, okay, the net operating income at stabilization is X. Therefore, the largest loan I can qualify for is Y, because I need to make that debt service coverage ratio of 1.25. And that's going to be one of the determining factors on just getting financing approved in general. So.
Good question. Good answer. All right. Are your rentals, you may have answered this, on a fixed variable rate? What's your average cash flow on these rentals? And I think some of those questions were answered along the way, but did you have anything to add to either one of those?
Yeah, they're all fixed. I don't like variable rates. They scare the heck out of me. I'm a fixed rate guy. I want to know today that if I'm buying the property, my rate is this, my monthly payments are this. Commercial loans, they reset every 5, 7, or 10 years. So you get financing that's amortized over 25 or 30 years as you would with a residential loan, but there's an interest rate reset period at either 5, 7, or 10 years, depending on your financing. So for those doing the math in the room, my building I bought in 2019, we're due up for an interest rate reset January 1. Great news. We didn't take like a 2% interest only rate like other operators. We took a 4% principal and interest. We've been paying down principal. We'll be plenty fine. And it's not even on my radar of concern, more so just watching it to figure out when we want to lock our rate in the next 6 months.
Great. Yeah, that was from MC. Thanks, MC. And he follows it up with another question. Have you encountered a situation where a unit is not making money or that investment is operating at a loss? How do you handle that? And where do you obtain additional capital to cover the loss?
I have not encountered a situation where an investment is operating at a loss. That gets dicey quick. The question would become, right, obtaining additional capital. So I can't say every, but 99.9% of the world that does real estate investments has a capital call clause within their LLC operating agreement as a limited partner, as a general partner. And again, 99.9% of the time, you are not obligated to participate in a capital call. So for instance, if a property needed another $500,000 and they did a capital call to their 50 investors looking for that dollar amount, 49 of those 50 investors could say, yeah, I'm not putting any more money into this deal. And it would just dilute their ownership, and it would fall on the general partnership to either try and make it up, secure private financing through a secondary lender or something like that. But again, I've never been in that situation. Off the cuff, if it was operating at such a loss, I'm more of a fan of, rather than trying to chase the market down, just beat the market down and be done with it. Cut your losses and be done. And actually, one of the properties that I toured last week is operating at a loss. For instance, they bought it around $95,000 per unit on a 36 unit. And I think my underwriting landed me at about, I'd pay $68,000 a unit for it. They know they're at a loss. They know they're in the red. They can't, their lender's on their back, and they've just got to cut loose and pull the ripcord and be done. So, I try and pride myself on cautious underwriting with a lot of what ifs built in, including like 6 months of principal and interest payments and things like that. So,
question. Cool. Thanks, MC. And MC follows it up with another one. MC, thanks for all the questions. How many limited partners are current in your group? I don't know. Maybe you can answer that. I'm not 100% sure I understand exactly what he's asking, but go for it.
Yeah, I think he's kind of asking how many limited partners I have. So InvestWise Capital is its standalone company. It's my sponsorship company. For every building I buy, I start a new LLC. And InvestWise Capital becomes the managing member of that. And then everyone else, the limited partners, are just investing into that. So if I'm going to buy a property at 123 Main Street, I'll probably start a really corny LLC of 123 Main Street LLC that then owns that one building. And so depending on the deal size, my first deal I did was, that 36 unit deal. It's smaller. There's 6 of us total in that, myself plus 5 other limited partner investors. The 71 unit deal we just did, like I said, we've got about 20 people into that. So it all varies. A lot of mine are repeat investors that continue to come back into different opportunities from there. But every deal is different, and we bring different people into each one, just based on sizing and capacity. And so we oversubscribed our last one, which was great. So.
Right on. All right, man. Well, that's all the questions we have. You saw Scott's contact info. You can rewind this a few minutes and see that again if you need it. Anything else you want to add, Scott, before we close this out?
Yeah, real quick. I noticed Eric just dropped a question in here. I do not own a property management company. I outsource to that. I've got 2 preferred vendors. One that's been in the business for 50 years, and off the record, there's some discussions between them and I on a long-term partnership opportunity there for management and syndication. 5% of gross revenue is what they charge. Like I said, I've kind of got 3 go-tos here in Minnesota, and they all charge 5% of gross revenue. So
there you go. Cool.
Awesome. Well, thanks so much, Brett.
Right.
I appreciate the invitation, and thank you all for joining.
Absolutely, man. Thank you so much, and hope to talk to you soon. Thanks, everybody.